Hi everyone, I'm Cara Huffy. I lead our deal advisory business in Northern Ireland. And I'm just going to touch on the capital structure and dealing with that, as well as the government loans that have been put in place. I am very conscious that some people on this call will not have sort of debt currently within their structure. But for those who do, this slide kind of focuses on that. And really this is around making sure that you're dealing with that debt structure, particularly as we go through this period of crisis and uncertainty. Obviously, we are seeing the entire banking system under a lot of pressure and putting a lot of people and their staff dealing with, the widespread connection that they need to have with their borrowers and those who want to contact them. So the key thing from us on a practicalities point, which I think everybody will get, is the early engagement with lenders. What I would suggest there, though, is that is kind of early engagement, if you also have term loans rather than just if you're trying to access government loan schemes. Engage early, but really make sure that that's with a clear articulation of your request and that you've got the robust information available for the questions that you will be asked. Also be thinking through your debt contracts, your loan agreements, making sure you understand them in fullness, and also really thinking about the voting threshold. So there's some really practical things about, who do you actually have to obtain consent from to look at those terms of loans and the covenants. I suppose what we're really focused on here is particularly thoughtful about covenant breaches that may occur. The Prudential Regulation Authority has encouraged lenders to take a flexible approach to covenant breaches as a result of COVID-19, and we're seeing lenders and borrowers seek to address those actual and potential covenant breaches through proactive discussion. Whilst the covenant breach to the end of March 20 in that quarter was maybe not as likely, clearly as we go forward into quarter June 20 and September 20, it seems likely that people will be looking at covenant breaches where maybe in the whole history of their business they've never been anywhere near a covenant breach. So I know that's very difficult for people and something that's different to what people have had to experience before. What we would suggest is please, look at your agreements, review the flexibility of those, the interest periods, speak to your banks around changing amortization payments and timing, and also looking very carefully at how definitions in your loan agreements are. So what is the definition of EBITDA, and in particular the definition of exceptional items will be an area of focus, and working through what a normalization to potentially the quarter most affected by COVID-19 might be. How does that look compared to the same quarter from the prior year, whether that's quarter one or quarter two, or indeed quarter three, depending how long this continues. Clearly, through what James had talked about in particular, there may need to be thoughts around accessing extra liquidity lines. So making sure that you can think about how you're drawing on existing facilities, consider drawing down on existing undrawn facilities in discussions with your financial stakeholders. And really that goes back to the practical steps from the start of this webinar, really modelling that out, looking at the scenarios, and really thinking about what's appropriate for your needs now, but also what's appropriate in 6 months' time, depending on scenarios that we can model. One of the areas that I'm working a lot with our clients at the moment on is people who've never had to look at debt before. So actually for people who are used to looking at term loan agreements compared to people who have never had to do so before. So certainly we're supporting in that in particular. And that's looking at the permitted security baskets, accessing ability to finance existing assets like property, debtors and inventory, and looking at asset-based financing as well. So lots to think about there, and I know that can be new for some people. I suppose the thing that we should touch on here is that, maybe this won't be enough. So in existing term loans and what you can get. So, there may need to be a point where raising new capital comes into thought. May not be now, but maybe in the future. So, we are looking at that in terms of the third-party funders out there to provide capital, and we are liaising with existing funders and providers to see who is open for that as the time comes. It's not something necessarily for focus right now, but something that obviously we're turning our minds to as we try and advise companies on how we get through this period of time and how long it goes on for. I'll move on now to then touch on the loan assistance that is available. I think a lot of you will have seen a lot about this in the press. There are a number of schemes, and you'll be aware of their names. I suppose I don't want to spend very much time at all talking about the COVID corporate financing facility. So that's the first one, CCFF. It's put in there for completeness. It's for very large companies that have investment grade levels, and really that is provided directly by the Bank of England and will be commercial paper. So I suppose the interesting point about that is, why is that happening? Well, really that's to provide funding to pay wages, suppliers, and boost cash flow. So really to keep the economy going and make sure that those larger companies can continue to pay the supply chain. The one I suppose then that's most frequently then referred to is the CBILS scheme, so Coronavirus Business Interruption Loan Scheme. Again, you will probably have read a good amount about this, but this was the first scheme that came up for SMEs with a turnover up to 45 million. The things I would want to touch on there is just making sure that, again, the practical steps we've talked about here in this webinar still apply. So please be thinking through your cash flow forecasting for that. Be ready to have management accounts, historical accounts ready, a business plan where you can show that there is a viable proposal to trade out of difficulty in due course, and a detail of your assets and your business. Lenders are, there's 40 accredited lenders, and they are all putting a lot of focus on getting through the very large number of applications for this and the new capital that's been asked for. For the smaller facility, you'll have seen that there has also been updates from the government in terms of things to help, and therefore the interest free for the first 12 months and no fees, that is covered by the government. There was also good and welcome updated guidance on for facilities of less than 250k, no personal guarantees were to be asked for, and principal private residents are excluded from the source of security. Just to touch on the eligibility for that, it has to be less than 45 million, and that is for UK-based activities, so group-wide, worldwide threshold, and 50% of the turnover must be from trading activity. And the loan is to be used to support primarily trading in the UK, and borrowers will need to self-certify that they've been adversely affected by COVID-19. So I think where we're helping our clients is putting that kind of information pack, the thoughts around how we apply for that, and how you prove what your crisis point has been and why you need that. The next loan scheme that you'll have seen the government announce, which kind of filled what was kind of classed as the gap between the very large scheme and the SME scheme, is for turnover between 45 million and 500 million. Unfortunately, in this one, we know less so far, but we have been told that it will be similar to the CBILS scheme, and it's to launch during April 2020. So we are awaiting that. I suppose the key differences I would bring out in that is, in contrast to CBILS, we expect that the interest will be payable by the business at commercial rates, so not by the government in that first 12 months, unlike the SME scheme. But that is not all finalised yet, and I just hasten to add that we're kind of dealing with incomplete information on this at the moment. But it will be by the accredited lenders on the British Business Bank website. And we'll keep Invest NI are keeping their website up to date, as will we, as more information comes out about that. So I suppose the key thing to think about here as I sum up is really around your short-term cash flow analysis, making sure that's there, seeking your debt capacity, understanding, are the government schemes the best thing for you, and thinking about the other options that you have available and looking at it across a number of scenarios that can help. I just want to touch on the grants. I know there's been a lot of press on this as well, but there is grants available. The Northern Ireland Executive has provided a one-off grant of £10,000 to businesses in receipt of small business rate relief. And that's being, if your bank details were with Land and Property Services, then those have already been paid, as we understand it. And if you had two bank accounts, they have not made the assumption on which bank account to use, so you just need to fill in an online form on the LPS service to get that. And the Northern Ireland Executive is providing a one-off grant of 25k to ratepayers in hospitality, tourism and retail sector, with a rateable value of 15k to 51k on their property. So hopefully that is something that, I think that came out quite early, so hopefully that is something that you've been able to access where you're eligible. The other thing to just touch on very briefly is interruption insurance. Insurance, you know, a lot of people have not been covered for pandemics and government closure, but please do look at your policy. There are very significant differences in a lot of my clients in terms of the insurance policies that they have, and therefore it is useful to look at that. The government has formally declared coronavirus a notifiable disease, so that has helped clients, some clients, seek compensation through insurance policies, so please do have a look at that. I just want to finish off, conscious of time, for 15 minutes of Q&A, just planning for the future. So I suppose as a firm, one of the things that we're thinking about now, as we've kind of gone through that very initial crisis management, is really the stand-up plan. What are the industry specifics going to be as people try and come out the other side of this? And really, what is the working capital impact going to be of that stand-up plan, which is not insubstantial in itself. So whilst we probably don't have time to go into that a lot today, we are working on that as a firm, and we do hope to help our clients in how they plan for the future of this and the cash flow forecast. That particular conversations at the moment around supply chain resilience and being able to, you know, provide comfort to your customers of how you will have resilience as you do go through a stand-up plan in the future. So I suppose trying to end on a more helpful note and hopeful note of how we do come out of this when it is appropriate and right to do so, when the government allow that.